Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello everyone. Today we begin with a new standard in the 500 series, SA 550 Related Parties. This standard is extremely important at both inter-level as well as final. Therefore, understanding this standard in detail becomes very important, as the examiners one of the favorite area for testing you. Alright, so let us get on having a good learning of the standard and understanding it perfectly. Now SA 550 talks about related parties. I am sure you all must have come across the word related party. In this standard, we are going to understand what is the auditor's responsibility with regard to the related parties and also with the transactions which are entered with the related parties. But before going into the details of the standard, there is one clarification which I want to make. Many students have a misconception, a wrong idea regarding related parties means wrong. Related parties means something the organization cannot do. Related party transactions are absolutely not allowed. Wrong. As I said, it is a misconception. Meaning to say, related parties, what they are, we are going to discuss now. But understand, an organization, an entity is allowed to enter into contract with its related parties. But when they enter into the contract with the related parties, they have to fulfill the requirements which are given by the respective standards, by the financial reporting frameworks. If they do that and they enter into contract with the related parties, then that will be absolutely allowed. Got it? Therefore, never have a mindset that related parties wrong. Understand, related parties is risky area. We agree, because risk of material misstatement is present both in unrelated items, in related items. But when you look at the comparison, related items, there is more risk of material misstatement, because understand the word related. That means the organization or the entity, the reporting entity actually knows the other party. So there is a possibility, a highest possibility that collusion could be there, manipulation could be there, fraud could be there. Because of which we believe, yes, it is going to be something which the auditor is going to focus at. It is going to be something where we are going to have more of our alertness. But you cannot say if it is RP, it is wrong. Wrong. That concept is not considered to be correct. Alright. So for our understanding, let us tell, related party transactions are allowed. But then we as the auditors are required to see that when the related parties exist, when the related party transactions are entered into by the reporting entity, whether they have been identified, whether they are accounted, and whether they are disclosed as required by the financial reporting framework. Correct? Now, every now and then I am using the word applicable financial reporting framework and the related party. Correct? Now, tell me, you all are now very clearly aware of who are responsible for the preparation of financial statement. Obviously, it is the management. And when you prepare the financial statement, it is you who has to fulfill the requirements of the standards. Be accounting standards, be the Ind AS applicable on you. Or maybe if there is a company, you also have section 188 to comply with. Correct? So it is ultimately the management who is required to adhere to these standards, to these provisions of the law. Correct? So while they prepare the financial statement, prima facie, it is their responsibility to prepare and present the financial statement according to the standards or the framework which is available. What has the auditor to do? Auditor is required to only do the review, that is the check of whether this requirement given by the respective standard, by the financial reporting framework, if it is a company, the company's provisions regarding related parties, whether all of these have been appropriately fulfilled and disclosed by the client. Whenever we study any particular standard, it is very important for us to know why. If we do not know why are we studying, you will never get the concept correctly. So we know there is Accounting Standard 18, related party disclosures, which is telling the management, look, when you prepare the financial statement, when you present the financial statements, If they are related parties, you have to give a separate disclosure for the same. You need to identify the related parties and you have to give the nature of the transactions entered. Correct? Now, we the auditors, as per SA 550, we are required to check whether what is given in AS 18, what is given in section 188 of the Companies Act, if the entity is a company, and if there is any Indian accounting standard Ind AS applicable, whether the requirement of these regulatory things have been complied by our client appropriately or not. Got it? So this is what the standard is telling us, and SA 550 simply gives the responsibility on the auditor. Look, auditor, if the reporting entity, that is in my example, let us take A Limited. If suppose your client A Limited has related parties, then you need to identify the related parties. If they have entered into transactions with related parties, then understand what transactions they have entered. And you have to see whether they have disclosed these related party transactions as required by the applicable financial reporting framework. That is the accounting standards, the Ind AS, or if it is a company, whether the Companies Act, the provisions have been fulfilled or not. All of this is what we are going to check. So this is the basic idea of SA 550. So from now on, no student is going to take a concept of related party to be wrong. No. It is complex. It is a significant risk because the risk of material misstatement is high because inherent limitation. Inherent limitation is what? Related party is somebody who is known to the client. And when it's known to the client, obviously there is a possibility of collusion, manipulation. They could collide together and together make a fraud. So though we agree it is high risk of material misstatement, it always did not be wrong. Correct? Logic is very simple. When you are going to have related parties, obviously there has to be an intention, right? If suppose I am the holding company, if I have bought the shares, major stakeholding of another company and made that company my subsidiary company, so I am A Limited, I am making B as a subsidiary company, obviously I require some benefit. Obviously there are going to be transactions. If that also I am not allowed, then what is the use or what would be the real intention for me to actually make the relationship? Got it? So RP transactions are allowed. But what is most important is their disclosures, their identification and accounting as per the applicable financial reporting framework. Now, I have repeatedly used the word related party, related party. So obviously a big question, what is actually related party? Alright, now. First of all, we will understand that if a financial reporting framework clearly gives the concept of a related party, like for example, AS 18 talks about what is considered to be a related party. Okay, in that case, we, for the purpose of this standard, we will pick up the related party understanding from the standard and check it here. That means we will apply it the same here while fulfilling SA 550 requirement. But suppose if the financial reporting framework is silent about a related party or gives very minimal information, in fact like no information about who could be considered as related party. Like AS 18 is a part of financial reporting framework, right? So AS 18 precisely gives the information about who the related parties are for a given entity, correct? So if that is available, we are going to understand the related parties from there. But suppose if the particular FRF does not talk or talks very little without giving a very clear understanding of the related parties, then in that case, this standard SA 550 gives an understanding of what would be the related parties to be considered by the reporting entity or what will be considered to be a related party for the reporting entity by the auditor. Okay? So what we understand, financial reporting framework, if they discuss the concept of related parties, then whom they call to be related parties, we are going to take them as related parties and then we'll see whether these kind of transactions are present. If they are present, what is the kind of transactions, etc. But suppose if the FRF does not discuss the concept, does not give you any idea of who the related party is, or it is not very clear, very minimal information is given, then in that case, SA 550 says, we are there to help you. So what SA 550 says? That there are certain things that you have to check, and if this kind of relationship is present, then they will be called as related party. So let us discuss which all they are talking, or what all other parties that they are discussing. First, suppose there is a person. this person is exercising significant influence over the reporting entity. Reporting entity is my client. I am the auditor and I am doing the audit of A Limited. So A Limited is my client. So this person, if he is exercising significant influence over my client, this person is called to be what? A related party. He could be promoter, he could be director, he could be any person, a shareholder, major stakeholder who is exercising significant influence over the reporting entity. Okay? Or it could be an entity, it could be another company Z Limited which is exercising influence over the reporting entity. Okay? So that means it is becoming a parent company and they are influencing or having a impact over my company or a control over my company. That is the reporting company. So this becomes the subsidiary and this becomes the parent. Or this could become associate and this could become parent. So this relationship also we call it as what? Related party. So two things. One, where a person is exercising control over the client. Second, another organization, another entity is exercising control over my client. This will become what? The related parties. In simple language to understand, in the company law language, holding subsidiary or holding associate. Understanding? Clear. Then, second discussion that they are doing is the reverse order, where my client is exercising control over another entity. Where it is exercising control over another entity. So this is also what? Related party. Understand, these are relative terms. So if holding is going to be a relative of subsidiary, subsidiary also will become a relative of holding. So if this kind of relationship is existing, we call it to be what? A related party. So first two things that we are discussing, where the other person or the entity is exercising control over my client, okay, or my client is exercising the control over the other entity. It could be individually or in between the intermediaries. We know the relationship. Chain holding is there, correct? So in chain holding, what happens? One company holds the other is holding the other. So in togetherness, what happens? Suppose if A is holding B and B is holding C, automatically the relationship will also exist between A and C, correct? So chain holding pattern that we call. So this entire loop or the entire chain, we call it to be what? A related party, correct? Then, third item that is discussed here is about, I'll give you three different examples where you will understand very easily. First, I have a company. Now, I'm not an auditor. I'm a regular person. I'm a person who's having a company. I have another company. There is another company which I'm having. So, two companies I'm having. I'm the owner of two businesses. So, tell me, here also I'm controlling. That business also I'm controlling. So, don't you think these two companies will then become what? Related parties. If these two businesses are owned by me, don't you think these two companies or these two businesses will become related parties? Yes. Suppose I am a director of A Limited. Similarly, I am also director of B Limited. So, the common management, it's going to be related party. Are you understanding? So, this we call it to be what? Another definition of related party explained here. Or, one more very interesting thing, we are Indians. So, basically we have relatives and relatives and relatives. So, let me take a simple example of me and my sister. So, suppose I am holding a business, I am controlling, I am having an ownership in a business. My sister is also having a business. So, when close family members are connected, that business will also become what? Related party. And these family members, me and my sister, will also become what? Related party. So, don't you think these transactions have to be assessed properly? Don't you think me and my sister together could collide, manipulate, do some kind of manipulation? Possible? Yes. So, very simple. We talk about common control. We talk about close family members. We also talk about is where there are going to be common key managerial personnel. Even those organizations where there's such kind of common things are there, even those will become related to each other. Got it? So, related party transactions basically, forget transactions, related party basically is given by the standard. How? First, the standard says, look into the financial reporting framework. If they have defined, like the AS 18 defines the related party relationship, if they have defined, we are going to adopt that for the assessing of whether related party transactions are there or not there. If FRF does not say anything or says something very little, then this standard will give you the guidance. Then this standard says, come to us, we will explain you which transactions the auditor will assess as related party transactions. So which are those indicators? First, where person or the entity is going to exercise control over my client's business. So there is a promoter, Mr. Y, or there is going to be a company Z Limited which is exercising control over the reporting entity. So this is related party. So for my reporting entity, this promoter Mr. Y or this company Z Limited becomes related party. Correct? Second, where my company, that is my client, is exercising control over another entity, that also becomes the related party. Correct? So I am A Limited. If I am exercising control over B Limited, B Limited becomes related party. If these two are not happening, then we have further discussion to be done. Where you see two businesses and these two businesses have a common control, common ownership. I am the owner of A Limited. I am also having the ownership of B Limited. So this is what? Common control. Correct? Similarly, if suppose my sister and me, these two different businesses, one held by my sister, another owned by me. These two again related party. Why? Close family members. Correct? Then, similarly, a key managerial personnel like a director. He is a director in this company also and that company also. We call it to be what? Related party. Correct? So this is the understanding of the term related party given by SA 550. Okay? But very interesting thing also discussed here is about an exception. Now tell me, government is holding so many organizations. So many government companies are there. Okay, like to give an example like BHEL, okay, BHEL we have. Then we have SAIL, Steel Authority of India. Okay, all these companies, there are multiple others also, many in fact, where government is going to control. Tell me, common control, no? Because government is controlling everywhere. So will you call all these companies to be related parties? If that is done, auditor will never finish the audit. Because if I take one government company as my organization for audit, and if I say every other company which is controlled by their government will become a related party, then my entire time will go in identifying the related parties only. So many companies in India which are controlled by the government, and if I have to assess all of them as related party, the game is over. Alright, so very simple, what they say is, there is an exception here. If suppose there is the entity which is controlled by the government, okay, in that case, common control, that is the same government, if it is exercising control over different other companies, those or entities will not be called as related parties. But they will be called as related parties when there is actually exchange of resource happening. That means suppose two companies, both are controlled by the government. These two basically do not become related parties. But suppose if they are having exchange of resources, that means this company is supplying some raw material here, correct? Or maybe this company is supplying something to this company. Some financial transactions are happening. Some supply of funds are happening. Some kind of relationship is existing. There are resources being exchanged. Employees are deployed here. In that case, if this kind of relationship is exercising or existing, we call that point of time those companies to be related parties. Got it? So two companies or two entities, if are controlled by the government, basically they are not related parties. They will become related parties when actually there is going to be exchange of resources between these two entities. Got it? Because logic is quite simple. If one entity you audit and all under common control become your related parties, then the entire time of the auditor will go in assessing related parties only. Got it? So it's not going to be possible. The standard makes it very clear. Though government is going to control multiple companies, every company controlled by the government will not be called as what? Related party to each other. So this is in totality the meaning of the word related party. So with this, you will be able to now understand what audit procedures we will follow, what is the auditor's responsibility, how will he carry on with the audit. Now, the basic objective of this standard is that the auditor has to actually obtain all the information with regard to the related party relationships that are existing and also the related party transactions. Whether the financial reporting framework is explaining about a related party relationship or whether it is not talking about it. In any way, it is the responsibility of the auditor that the auditor actually finds the evidences or obtains evidences regarding what kind of related parties are existing, what is the nature of the transaction, and see whether they have been appropriately disclosed or not. So the basic idea is, in this entire standard, we will be understanding that it is the responsibility of the auditor to check whether every related party has been identified and if there has been a transaction with that related party, whether transaction has been accounted for and whether it is properly disclosed. And so far, whether the financial reporting framework has been complied so that you could end up saying whether the financial statements give a true and fair view or not. Understand? The major idea or the objective of the standard is to understand the related party relationship. Why? Because this is an indication of a fraud risk factor. We understand that RP transactions, wherever they are involved, they are giving a doubt regarding a risk element to be present, an area of significant risk, because of which there is a possibility that whenever the auditor is doing the assessment of risk, or when we do SA 315, identifying and assessing the risk of material misstatement, these transactions also should be taken into consideration because these are areas where significant risk relating to fraud is possible. Got it? So what the standard says, look auditor, it is your responsibility that whether the financial reporting framework talks about RP relationships or not, it is your duty to obtain the understanding of all the related party relationship. And you will see that the nature of the transactions or the nature of the relationship, whether it is an indicator of any fraud which could be present, correct? So we need to assess it as a part of our risk assessment procedure in 315. When we do risk assessment, we have to also give due regard to all these places where we believe, there is going to be a related party and this is a risky area, significant area for risk, correct? Second, and you will see that if suppose a financial reporting framework discloses clearly that these are related party transactions, these are related party relationship, then the auditor should obtain sufficient appropriate audit evidence that these which are required by the financial reporting framework have been identified is recognized, then accounted for, and then disclosed as required by the financial reporting framework. Correct? So, two simple objectives. Whether FRF says or not, you have to analyze and assess RP relationship and the transactions as a part of your risk assessment procedure. Because these are the highest place of fraud indication, fraud risk factor it is. Second, you will see that if FRF is telling that yes, this is the related party relationship, whether it has been identified, disclosed and accounted for correctly. After doing these two, only you will be able to give a conclusion whether the financial statements are able to give a true and fair view or not. Clear? Now, having understood this, now let us see how will the auditor assess the risk of a related party relationship or a presence of related party transaction. So, what is the risk assessment procedure which the auditor will adopt? Before understanding the risk assessment, we need to understand that who are responsible to actually identify and disclose about the related parties. It is obviously the management, because management is required to prepare the financial statement. Management is required to present the financial statement. So, in that case, obviously it is going to be the management who has to identify all the related parties, have to account for them, have to disclose them, correct? So basically, when I do risk assessment, the first thing that I am going to do is, I will communicate with the management, talk to them, understand their understanding of related party transactions, talk to them, inquire with them, know what are the controls that are placed, etc., etc. So this is a broad framework of how an RAP will be conducted. So now, let us go on in detail and check what will the auditor do as a part of his risk assessment procedure? That means when he wants to identify whether RP is present, if RP is present, if there is a transaction, if transaction is there, whether it is disclosed correctly or not. In order to understand this, what will be the risk assessment procedure adopted by the auditor? Now, the first step in the risk assessment procedure will be, we have already done SA 315, identifying and assessing the risk of material misstatement. So there we know that we need to analyze, that means understand the entity, okay, and try to assess the risk. Same thing here we'll be doing. We are going to understand the entities, related party relationships and the transactions that have been entered. So that is the first procedure that we are going to perform. How do we understand? Very simple. You will have to inquire with the management. Sit across the table with the management, discuss with the management. Ask the management, who all are your related parties? How many related parties do you have? Who are they? Then the management will give you the identity or the understanding of the related parties. So then you will question them, what are the relationship that you have? Is it a holding company? Are you its subsidiary company? Is it your associate company? What kind of relationship do you have? Third, after understanding the relationship, ask what is the transaction or the nature of transaction that you have entered with the related party. Got it? So first thing is, you need to understand the entity's related party relationships, okay, and all the related activities to them. So what we will do? The best person in the organization is the management, because it is their duty first to identify them and report them in the financial statement. So obviously I will sit across the table with the management, have a communication with them, ask them, management, tell me who all are your related parties. How many related parties do you have? If they say, okay, we have 10, ask them the relationship that is existing. What kind of relationship you have with them? And then they give you the kind of relationship. Then ask them, during the current year, did you enter into any transaction with those related parties? If yes, then obviously we are going to move in for checking out the other requirements. Got it? So we do 3 inquiries basically. First, ask, what is the identity of your related parties? Who are they? Second, what is the relationship that you have? Third, did you enter into transactions with them during the year? See, sometimes it is possible that you could be the auditor for the prior period also. So you already have some information about the related parties. So you can also question the management, last year and current year, have there been any change in the related party? There could be possibility, right? Prior period, few were there, now they are not there. Or some new parties have been coming into existence. That could be possible. So now the management tells you, okay, we have 10 related parties. Then they explain you the relationship. Then out of 10, maybe with 4 related parties, they have entered into transaction in the current year. So they have explained you everything. Now you as the auditor have to perform risk assessment procedures to ensure that whatever information now the management has given, whether based on that, whether they have accounted it correctly, whether they have disclosed it correctly or not, adequately accounted, reported, disclosures, whether everything has happened correctly or not. You will also check whether did the management actually have controls in place for the purpose of authorization of significant transaction with the RP. Okay, that means whenever you are entering into contract with related parties, significant contract with related parties, then in that case, you have authorization levels. So there could be a possibility that the managing director has to approve it, or there could be a possibility that 2 levels of approvals required. Correct? Maybe there will be one senior manager, then directly the position of a managing director. So you have a control that when you are entering into transaction with an RP, okay, you would require what? 2 authorizations. So check whether management has put in controls or not for the authorizations of the related party. Correct? Because controls have to exist. Related party is a significant area of risk. There is a possibility of fraud. So authorization levels, controls are very, very important. So the auditor should ensure whether authorization controls were there or not there. Third, one very important thing we discuss as a part of the standard, that is relationships or maybe transactions with the related parties which are outside the normal course of the business. What is normal course of business? For example, I am into manufacturing. So what should be the normal course of activity? I should purchase the raw material, process into the finished goods and sell it. That should be my business. If I'm a trader, I should buy and I should sell. That is what normal course of my activity. But tell me, if all of a sudden from nowhere, the manufacturing entity is financing somebody, providing a loan, correct? Giving some money, financial assistance to somebody. Is this activity a part of your regular course? No. Because in your business agenda or in the business criteria, do you have this activity addressed? No. So that is something which is outside the course of your regular business. And that, if it is done with related party, again a very serious area of risk. So the auditor should see whether there has been a proper authorization of any transaction which has entered with the related party, which is outside the course of the normal business. Got it? So very simple. When we do the risk assessment, we are going to understand the entity's related party relationships. And how do we understand? Very simple. We will talk to the management. Tell us management how many related parties are there. So identify. Then understand these parties, what is the relationship. Then if relationship is explained, what transactions did you enter? After that, the auditor should ensure that once they have disclosed to you the related parties, you will see that if the transactions have been entered, then in that case, they have been appropriately accounted for, reported and disclosed as per the financial reporting framework. Then you will see that this area is the area where risk is involved. So you have to also ensure controls are in place. So you will check on the authorization levels. That means you will see whether proper authorities have authorized this kind of transactions, significant transactions with the RP. Okay, like for example, I am a company and there is another company which is owned by my father. Okay, where he is a KMP and here I am the key managerial personnel. So obviously we two are having a kind of relationship which is quite very close. So in this case, obviously if there is going to be a dealing between both, then there has to be proper authorization in my organization also. That means my organization is going to very clearly tell me that this relationship or this transaction which I am going to enter with that company, here I should be taking approvals from 2-3 other people also. So these approvals which are happening, these are nothing but controls. So these controls have to be in place. Correct? Third, if an entity is doing something beyond its normal course and that transaction is entered with a related party, then auditor should check for the authorization there also. Because these are highest possibility of risk. And here the risk is of fraud, which is very, very serious. Because of which we have to check all of this very much in detail. So we understood the first step in the risk assessment, that is we are going to inquire with the management. Second very important thing is we have to be alert during the course of our audit. That means entirely when we are performing the audit, including as a part of our risk assessment, we have to be alert with respect to any indication of where there could be a related party relationship or a transaction which we were not aware earlier or which the management did not disclose to us when we questioned them. So there could be a possibility that there is a loan agreement that you came across, or there could be a possibility of any other document which you came across, and when you inspected the document, you came across a party which was not disclosed to you by the management. Because when you question the management has to tell you everything. But the management has not disclosed. So you have to be very alert with respect to any situations like this. So where you believe that yes, that when through your observation, through your inspection, if you come across any related party which was not disclosed to you earlier, in that case, you have to be alert and understand what is the related party all about, what is the transaction. Correct? Then, suppose during the course of the audit, you came across an activity which is beyond the normal course of the business. So in that case, again you will be alert. You will see, okay, a trading organization has given finance to somebody. So you will now check in detail about the finance agreement, because this you will first check whether is this done with related party. And if it is done with related party, you will do the assessment very, very clearly. Why? It is an indicator that there could be fraud involved. Got it? So what you do next thing is that you need to maintain alertness during the course of your audit with respect to the related parties. There could be a possibility that when you're checking a particular transaction, when you are doing the audit actually, You came across certain parties or relations which management did not tell you. In that case, obviously, you will then see what is the party all about, what are the transactions, what is the nature of the relationship, everything, and do the assessment of did they really did not know about it or did they try to hide it from you. Got it? So this is going to give you an idea whether it was intentional or it was unintentional. Second, if suppose you come across a transaction and this transaction is something which is not regular, it is outside the normal course. In that case, what will you do is, you will check details of that particular transaction. More importantly, you will check whether in that transaction a related party is involved or not. Because if a related party is involved, the risk of material misstatement will be high. And in that case, there could be a possibility of some kind of circumvention, circulating of some kind of money, siphoning of funds, or manipulation could be there, because of which you need to be alert during the audit. So we did what? 2 risk assessment procedures by far. First one is what? That you have to understand the entity, okay, the related controls of the entity regarding the related parties. Correct? That means you have to obtain the understanding of the entities, related parties, and the corresponding controls that are present. Second, you will also understand whether this particular entity, if they have related parties, that means you have to be alert during the course of the audit. You have to maintain professional skepticism as and when you perform the audit. Correct? Like when you look at the documentations like income tax returns, or maybe when you do any kind of filing with the government, when there are some loans entered into transactions. Okay, so these all documents we are going to check in detail to understand whether are these relationships or are these transactions giving you any indication of any related party being present. And if this RP is present, was it disclosed to you by the management? And then if it is not disclosed by the management, it is an area of risk where you will apply further audit procedures and then assess it in detail. Got it? Then, what would be some more examples for something which is outside the normal course of the business? When you go through your notes, I have given you a few more examples where you will understand what would be something which is outside the normal course. Okay, like for example, corporate restructuring. Okay, that is also something that we don't do as a normal course, right? So when there is a restructuring process happening, a scheme like that, then whether it is involving a related party. Got it? So these are going to be some areas where we are going to check for the purpose of our risk assessment. And third important area that we discuss now is, the third is where the related parties are exercising some kind of dominance. This kind of dominance, okay, without having any corresponding control to it. Like for example, a group of people dominating the entire business, or a single person dominating the decisions. And there are no corresponding controls, no compensating controls. Controls as in, what that person is telling is becoming final. To give simple example, like suppose if there is a board meeting going on, okay, and a significant discussion has happened and majority of them have agreed. Maybe there is a loan to be taken, or maybe there is a new contract to be entered into, or maybe we are entering into some kind of tie-up. Something is very beneficial for the organization and here the entire board of directors are okay with this. But the person who is exercising the control is sitting in the dominant position and he tells, I am not allowing it. So in this case, tell me, this particular thing, don't you think is kind of a risk? Correct? Because there could be fraud, there could be some kind of, unnecessary dominance which has been influenced on the decision making. Got it? So what happens here basically is that if you see when there is a dominant control, when you see there is one person or a group of persons are controlling everything, these are the indicators of fraud. How? Because see, if suppose this particular loan agreement which I wanted to enter and all the BODs have agreed, or maybe if this tie-up, this particular BODs are all okay with it, they believe it to be very beneficial, but there is one person who is having a control and has a dominant position with the power to influence, and he says, no, I don't agree. That means this person is trying to do this kind of tie-up with one of his related party. So this is an indicator to the auditor, fraud could be there. Correct? So the assessment will be involved. Or maybe there is a possibility that a significant decision has been taken. Okay? a very important decision has been taken and already everybody is like, okay, this is a very good project, let us move in. And then the related party says, I don't give my approval. Maybe the way of structure is such that these group of people who are in the dominant position, they are going to give the final approval for anything that is discussed. So in that case, suppose there is any project which even if it is beneficial, the company is not able to take up because the final approval has to come from whom? Related party. And if the related party, if suppose something is beneficial to the company and they are saying will not allow, something is wrong. That means if they are a part of the organization, everybody will think about the benefit of the organization. And if they are not giving the final approval, even after understanding the project accurately, that means there is some risk involved that they have a strategy that this could go somewhere else. Or this funds or this kind of arrangement, they could have planned with somebody else, and that somebody else could be what? A related party. Got it? So third point is where we are going to see if there is a dominant influence, if there is a dominant control by the related parties. Okay, then in that case, the related parties, if there is a dominant control by a person or group of people, okay, then there is an indication that there could be a related party, there could be a kind of transaction to be entered with the related party, and this is the area of risk for us to be assessing it. Got it? So what are the three things that we study? Very simple. Under risk assessment procedure, that is, we know now related parties up there, and related parties means what? High risk of material misstatement. So when the risk of material misstatement is going to be high, the auditor has to assess it properly. So now, how will he try to understand? So he's going to inquire with the management, obtain the understanding of everything. He has to maintain alertness throughout the course of the audit to see if there are related parties, any transactions entered with them. If something is beyond the normal course of the business, you have to check in detail whether this is with the related party, because that is then something significant that we have to come across. Then you will also see that if there is a group of people or there is a particular person in the organization who is in the dominant position, then they should see that why is this person not allowing something which is beneficial to the organization. If he is exercising his influence in a negative direction, there could be an existence of a related party and a transaction to be entered with the related party. So all of this should be considered by the auditor for the assessment of risk connected to the related party. These all things will enable the auditor to understand whether related party is existing. If existing, what is the nature? If you understand the nature, is there a relationship, a transaction? And if there is a transaction, whether it has been identified, accounted and disclosed correctly. Because any of this is not done, it is a risk that we have to look into for detail. Got it? Now, just to go back again a little, where I told you there are three procedures. One is where you understand the related parties and the related activities. Second, I told you have to maintain alertness during the entire process of the audit or when you are inspecting documents and all. So I gave you a few examples of what documents you have to refer. One more very important discussion there is that when you obtain confirmations from the bankers, from the external legal counsel, okay, so when you get confirmations from them, those confirmations also you have to analyze and check whether any related party relationship is existing. Got it? Or maybe there could be a possibility that the minutes of the meeting or between the shareholders you have, or maybe the board meetings and all, these also you will take into account to understand what is the discussion. Is there any kind of transaction to be entered with the related party? Got it? So this is very, very important for us to understand that when we do the checking or inspection of the documents, or when we are looking at the records, we have to maintain alertness. We need to be professionally skepticist. Very critically we need to assess this to understand if there is an existence of the related parties. Got it? Now, so with this we have understood how the auditor is going to apply the risk assessment procedures for the purpose of understanding the risk associated. Okay? Now, suppose after performing all of this, the auditor now comes across some ideas where there is a problem or there is something which is known to the auditor. So how is the auditor now going to respond to the assessed risk? So what kind of risk could be identified by the auditor and how are we going to react to this kind of risk by using our audit procedures? So here we are going to have the discussion. Like first one we take up is where when you perform the risk assessment procedure and discussed with the management about, tell us about all your related parties, Tell us about what is the nature that you have with them, or what type of relationship you have with them, or what is the transaction you entered with them. The management actually did not give you the information of all related parties. That means there have been something which has not been disclosed to you, and as a part of your RAP, you came across a particular entity or maybe a particular person who happened to be the related party and which was not told to you by the management. Now here are two possibilities. First, inherent limitation. Management himself must not be knowing about the related party. See, there is a possibility. Companies are huge. So in that case, do you think every related party will be understood by them? No. So there could be a genuine mistake done by the management where they will not be able to identify the related party, and because of which they will not be able to communicate with you. Very simple example. When you have joint families, when you have huge families, all relatives here and there spread across. So when you go to any functions and all that, you will meet your relatives and then you are introduced to them. At that point of time, you come to know, yeah, that person is my relative. Got it? So obviously, there could be a possibility that somebody is your relative and you only do not know about it. Very obvious. Same thing here also, this thing will happen where management maybe genuinely by themselves is not aware that this particular entity is its related party. So in that case, they have not disclosed it to whom? The auditor. So there could be a possibility that something completely new which was not identified or disclosed to the auditor is now come across. Correct? So in that case, how will the auditor assess the risk? So let us take an example and understand this, quite interesting. So now when you were doing your RAP, you were sitting across the table with the management and the management told you, we have 10 related parties. You said yes, and then you were doing your audit based on their understanding. But then while the course of your audit, you came across a particular document which introduced you to a new related party, which the management did not tell you. So now we are in a position where management has disclosed you 10 related parties. Now you came to know somebody new who is a related party, an established fact that yes, that person is the related party where management has not told you about it. Now tell me, in that case, how are you going to respond to this assessed risk? This one entity which is now identified by you, don't you think will create multiple doubts in your mind? Yes. So you need to respond to this assessed risk. So what you would do is, immediately you have to communicate this information with your engagement team members. Tell them, discuss with them, tell quickly to them that look, we have identified a related party, because they also will become alert that there could be a possibility, some more areas also there could be a manipulation, some more areas also we could identify undisclosed related parties. So first thing, the auditor, once he gets to know about it, communicate promptly to every other engagement team member, because they also will become alert that there are some more. Got it? Then next, you will tell the management that management, these are the additional related parties that we have identified. Now you have to identify them. That means first of all you have to disclose it. Identification we have done. You have to disclose and account for it as required by the financial reporting framework. So you have to inquire with the management, tell the management that look, this is one more entity that we have identified which you have not disclosed, you have not accounted. Now you have to account for the same. And also question the management, look management, you told us, right, that you have controls regarding identifying the related party. You said you have controls in place for accounting. You said you have controls in place for disclosing it correctly. So you told us controls are there. Give us an answer. Why did your control fail? Because if you had control, how did this particular related party go without anybody's knowledge? How did your other personals or other people in the organization did not come across this entity to be a related party when in fact it is? And how did you not do the disclosure? How did your control fail? Question the management about it. Got it? So tell the management, look, we have identified the 11th related party. This is not accounted for in the books. You have to account for the same. Second, ask them why. Why did you do this? Okay, how did your control fail? Got it? Then. Now this transaction which you have identified, you will perform substantive audit procedure on it and find out whether it is complete, whether it is accurate, whether it is accounted for correctly, whether calculations are done correctly or not, whether everything is particularly in detail or not. Got it? So this is what you will do the next thing. That is, you will perform substantive audit procedure. You simply cannot say you disclose and you finish off. No. You have to check whether it is really done like that or not. So you will perform substantive audit procedures and find out whether what has to be accounted has been accounted, how it has to be accounted has been accounted correctly or not. Correct? That is what you will do. Now tell me, when you found out one, don't you get a suspicion about something more could be there? Got? So here you would now get a doubt that you are going to review and recheck some more areas so that you reconfirm yourself that yes, this is only one which we could come across. So what you would do? You would do the reassessment to ensure, are there any other relations which the management has not disclosed to us? Is there any possibility that we could come across something more which management has not told us? So in that case, you have to extend your procedures, you have to perform additional procedures and come to a conclusion or an understanding that there are no other related parties, or at least an understanding to yourself that yes, related parties there or not there. Clear? Then, last but the most important one here is, if suppose this omission of really not telling you was a reason which was purely intentional. That means for the purpose of some manipulation, for the purpose of some collusion, okay, intentionally management has not told you. In that case, obviously it is an indicator of fraud. So you will check whether is this an indicator of fraud, and if yes, you will perform the procedures given by say 240. Understanding? So very simple, understand there is an inherent limitation with regard to your related parties. See, when we also talk about inherent limitations of audit in SA 200, that time only when we talk about the other factors, then we talk about related party relationship, correct? So when we talk about, see, limitation of time and cost, when we talk about, audit procedures, or maybe the type of financial reporting, we also give them the last there as other factors or other reasons for inherent limitation. In the other reasons, we also write about related party transactions. So inherent limitation is there. Two inherent limitations are possible. One, management really did not know. They were not aware that this particular entity is considered to be the related party. So that is a possibility that they have not told us. Second is that they are intentionally hiding it from you. And if they are intentionally hiding it from you, what can you do? Both of these are inherent limitations. Got it? So here if you understand that this omission of information to the auditor, if it is really incidental or purposeful, then in that case, the auditor should ensure whether there is an element of risk involved here. Got it? So this is when you are getting introduced to new parties or new relationships which were not disclosed to you by the management while you were performing your risk assessment procedure. So very simple, you will talk to all the engagement team members, make them alert that look, we have got something like this. Second, you will perform procedures, substantive audit procedures, and understand whether everything is accurately recorded. Tell the management what we have identified, you later do the recording. Question the management, why did your control fail? This is going to give a doubt in the mind of auditor. Something one we came across, there could be something else also. So would extend the procedure and see whether any other related party which is undisclosed has been identified. And moreover, if this is an indication of intentionally being done, then you have to be careful that is this a reason or is it an indication of fraud intentionally to be committed by the management. Got it? So this is when a new related party has been identified, which is not disclosed earlier. So this is the first kind of risk that we come across. What is the risk? Not told to the auditor, but the auditor understands. The next risk which the auditor could identify would be regarding the transactions which are beyond or outside the normal course of the business. As I already gave you a few examples of normal course, let us pick one from there. We will take a particular business which is having its major activity to do as a trading, buying and selling, then do trading activity. Okay, now maybe they are buying computers and they are selling computers. So the line of activity is buying and selling of computers. Now this business, the related party let us consider to be a promoter. one of the promoter is asking for finance from the company. So if they come and purchase the commodity from us, we have no problem, we'll sell it to you, you can take it, no problem. But here we are trying to extend financial assistance to a related party. Now this extending of financial assistance to this related party, is it the normal course of our activity or is it beyond our scope? Beyond our scope. It is something very unusual, something that we don't do as a part of day-to-day activity. So don't you think this is something which is outside the normal course? Yes. So in that case, where this kind of activities happened, the auditor will then respond to this assessed risk. How? He will try to understand, looking at the documentation, that what is the rationale, what is the reason for the purpose of this particular transaction. Why was this transaction entered? What is the logic? What is the reason for this kind of transaction to be entered by the organization? Why did the organization actually do something which is not required by it or which is not in the ordinary course? Is there a rationale behind it? Or is there any indicator of a fraud? There could be circumvention of money here. So in that case, you could see that why is this happened? Then when you question the management will give you explanation that we have given loan to this person, we have given for this person and all. Then see that you obtain evidence that whatever the management is telling and the terms of this agreement, they are consistent. You have to check that. You should also understand that all of this, somewhere or the other, a related party is getting benefited. Something very unusual is happening. So you have to be very careful with respect to its accounting, its disclosure also. That means do which is outside the scope, no problem. But what the standard is telling is, even if you're doing something which is beyond the scope, beyond your authority, okay, beyond your ordinary course, see, beyond the scope basically becomes wrong. Beyond your regular course of business, if you try to do something that, and there a related party is getting involved, then in that case, everything has to be properly identified, properly accounted and properly disclosed. If this is not done, this is an area of misstatement, and then this will definitely lead the auditor to give a modified opinion. Understanding? Because this is something first outside the course of your activity. In that case, when you're questioning the management, they don't have a proper rationale to give you, a proper justification. If this is something which is prejudicial to the interest of the company, then it is again dangerous. On that, if it is related party, you have to understand the explanation, whether it is really consistent with what you are telling and what you are doing. Correct? Most importantly, related party. You have to identify, you have to account, you have to disclose. All of these things you have to do. And only then we are going to consider it to be properly disclosed, properly accounted. Otherwise, this will straight away lead for what? Modification, because it is an area of significant risk, and if there is no proper evidence that you can obtain, or if the management is not answerable to you why they have entered into contract like this, then in that case, an area of significant risk which the auditor will evaluate, and there is a possibility that this could lead to a modified opinion. Understanding? So this is the way in which you are assessing the next risk, which is talking about what? That you are doing something which is outside the normal course of your activity. Correct? Then, third risk area is all the related party transactions have to happen at arm's length price. Arm's length price as in the way I am going to deal with an outsider who is completely unrelated to me, in that same way I have to also deal with my related parties. So if I am in the business of selling the computers, at what price I am selling the computer to an outsider who is completely unrelated to me, at that same price I should be selling it to the related party. Little bit discounts here and there would be fine. Okay, some minimal discounts are absolutely okay related, no? So you obviously will be having that kind of courtesy that you will be reducing a little amount. But exorbitant, huge discounts, unusual discounts, that will not be allowed. So you have to ensure that the related party transactions are happening at arm's length price. What is arm's length? The way I deal with a particular person who is completely unrelated, in that same price I should be dealing with the related parties as well. So that price at which I am going to deal with, we call it to be arm's length price. So we as the auditors have to ensure that the transactions which have happened with the related parties have happened with the arm's length price. Just don't listen to the management. You have to actually understand by obtaining evidences, sufficient appropriate evidences, that when a related party transaction has been entered, that transaction is actually happened at what? ALP, arm's length price. Very, very important. So this is what we talk about in the assessment of the response of the auditor to the risk which is assessed. Okay. So we broadly discussed into three. First, where ordinarily management did not tell you and you as the course of your RAP identified a related party. How will you deal with it? That is the first response. Second, you were doing the inspections and you came across the matter and this transaction is something which is beyond the normal course of your activity. So you will check whether everything is correct. What is the reason for this kind of transaction? Is it prejudicial to the interest? If related party is involved, whether it is properly accounted, disclosed, everything, correct? Then you would ensure that the related party transactions are happening at ALP, arm's length price. And if they are not happening, then this is something really wrong, correct? ALP, you simply don't have to listen to the management. Management says, yeah, we have done at ALP. No. You will apply the procedures, you will obtain sufficient appropriate audit evidence that yes, the transactions have happened at arm's length price. Now, one very important point here is, you know, whenever there is a responsibility of the management to do something, then as a part of obtaining the audit evidences, the auditor will obtain written representation from the management that look, we have identified and disclosed all the related party relationship and we have accounted for all the related party transactions as required by the financial reporting framework. That means according to them, they have not hid anything to the auditor. Got it? So you have to compulsorily obtain written representation from the management regarding their identifying, regarding their disclosure, regarding their accounting of the related party relationship also and related party transaction also. Understand, disclosure is required for both relationship also, and if the relationship there is a transaction, both. Understand, if there are 10 related parties, there could be a possibility transaction is only with 4. So both the things have to be disclosed, even the party, even the transaction. So both have to be accounted for and disclosed correctly. Got it? So you have to compulsorily obtain a written representation from the management. And the last part of the standard talks something very simple. It says, unless all the TCWGs are not involved in the management, you have to communicate the significant risk which you have understood about the related parties with those charged with governance. Okay? That means obviously if all are involved in management, everybody is the same. But if suppose you have particularly even a higher authority and that has not been involved in the management, then in that case, you have to inform about the significant risk that are involved in connection with the related party with TCWG. Documentation of the standard is very, very simple. You have to write the names of all the related parties which are identified and the nature of transactions that you have entered with the related parties. Got it? So this standard actually in detail explains to you what is the relationship of the audit or what is the responsibility of the auditor with the related party transactions and the relationships which are identified in the financial reporting framework of the reporting entity. So it becomes very important and understand related parties is a significant area of risk. Complexity is there, because of which as an auditor, this becomes one of the significant areas where we are going to focus our attention, because of which our understanding should be very clear while the performance of our audit.